Creating the estate with life insurance. We're going to talk over lots of things today, mainly about how we can create an estate when maybe there isn't an estate that's large enough to be passed on, or maybe you need to enhance it still. It's something that can create extra leverage is what we call it. So we start with, what you already have, and we can make it how many times greater through a leveraging product like life insurance. This program here is part of our seminar series or webinar series that we've been doing since February. So it started with the essentials, which was just an overview on government benefits and correct beneficiary designations, account titling, that kind of information. And that was done on early February. We then did a deep dive, which was a much more advanced look. It was looking at the special needs trust and what type of documentation that looks like, how people should, disabled individuals should properly inherit funds, and how we can even determine how much is needed to pass on to these individuals. And then after that, we started these virtual breakout sessions, and those sessions started with a 529 ABLE, which is a really neat plan that is much like a Roth IRA, where you can save without taxes on already taxed dollars, and as long as it's used for a qualified expense, you can pull it out without tax. So it's very cool. Lifetime income that covers mom, dad, and kids on March, it was done back in March, and that was just saying, how can we get income that can cover you and your kids for your entire lifetime? And then we did growing assets on top of market growth, so we could get enhanced growth in the market, and that would make it so that, again, there's some leverage. You have so much an asset, but it can give you even more than that at the time of retirement, and then or at the time of even death, to push that asset onto the kids. So today we're going to just be talking about creating the estate with life insurance. Like I said, next is protecting the caregiver's estate. That is through also some insurance programs on how and why it's so important that we protect the caregiver's estate, so we can be ensuring that there are assets left to care for your heirs when you're gone. So all of these past webinars have been recorded. Today's is also being recorded, and that is what makes this accessible on our website at any time that you need. So, like I said, today's will be recorded, and it will be on our website within the next few weeks. Go ahead and look for the others if any of these sound interesting to you on there as well. So the voice that you're hearing today is Carrie Waters Schmidt. That's me. I am the founder of Equanimity Wealth Planning and Investing, and I have a master's degree in financial planning. I am a certified financial planner practitioner, which is in the industry often seen as CFP. And I have several specializations. I work with the LGBTQ community for their financial planning, and also in unmarried individuals, or unmarried couples, sorry, special needs financial planning, obviously, and planning for recent divorcees. So I also work with folks on being socially responsible in their investments, and that is an offering that it just has you look through your investments under the hood and find out if they are aligned with your moral compass. I've been the Yoga Autism board president since 2018. I have found many different ways that we can help folks. So obviously financially, and then also through this nonprofit program too. And behind the scenes is Terry Beekner. She is going to be doing all of the behind the scenes work here. And she is our director of special needs planning at Equanimity Wealth Planning and Investing. She's been in finance for over 30 years, and we're so very lucky to have her. She has many specializations. The 529 ABLE and trust funding strategies, permanent life insurance, fixed guaranteed income producing products, long-term care insurance, and disability income insurance. We should have been having her talk about all these things today, but I took over, so you'll just get stuck with me instead. Okay, so we're going to get started on this special needs planning life solutions, creating the estate with life insurance. Okay, so we're going to start with what is a special needs trust? So that is recapping some of the important players in the game. And so the special needs trust is a vehicle that provides financial support for the benefit of an individual with physical or mental disabilities. And sometimes it's even referred to as a supplemental needs trust. We call them often SNTs in our business, so you may have even seen them that way. And the trust's principal and earnings, so the amount you deposit in is your principal, and all the earnings supplement the disabled beneficiary's care. So if we have a properly drafted special needs trust or supplemental needs trust, it can help ensure that the beneficiary will remain eligible for government benefits that can cover their basic needs. So they're pretty important in this space here. We have sources of government benefits. So the funds from a special needs trust are not used to pay benefits that are provided by government programs. So rather, these trusts are meant to preserve your SSI or SSDI and Medicaid, as these are both means tested, the SSI and Medicaid anyway, are means tested programs. And what is important to think about with each of these valuable programs is that they are government controlled. So let's see here. That means that control is not in the family's hands. The benefits are and their amounts can be changed by legislation. So that's very important. You don't have the power to dictate over what they look like or how they're going to pay. Medicaid provides health care benefits to those who cannot afford them, and the provisions will vary by state. Supplemental Security Income, or SSI, provides a small monthly income to be used for basic needs like food and shelter. When we say small, it's about $900 is about where that's at. And many states have their own programs that may be combined with the federal SSI benefits. Let's see. So we've got then Social Security Disability Insurance, that's SSDI, that pays a benefit to those who cannot work due to a medical condition, but have been covered by Social Security through working earnings, or their parent has been covered through that. And so that is not means tested. That is something that is, like I said, not means tested, but it is still considered a government benefit. And again, we are unsure of how that could be played, where that could be changed, the amounts that are paid. Okay, so we now are going to talk about funding the Special Needs Trust, because there are many ways that we can get money into the plan. But once money is in there, it can't come out unless it is coming out for a certain expense, right? So because money cannot be removed from the special needs trust except as a trust distribution, many parents, they'll only fund the special needs trust during their lifetime very, very minimally. In fact, many parents that I've seen, they just have it set up to become something that can get money into it once the parent is passed on. Okay, because while the parent is alive, a lot of times they have other ways of paying for the other supplemental needs, right? So it's very minimally funded during life. And so a majority of the dollars that gets in there is often at death, and a lot of that comes from life insurance policies. Now, qualified retirement plans, that's like this first little box that we've got sitting here. They incur taxes when they are distributed. And most recently, a new law came out which says that the money from those plans needs to be paid out completely within 10 years of the original owner's death. So it will reduce the net amount that is available to the trust. So if you had $100,000 that was paid to the trust in a retirement plan from a pre-tax account, has to be closed out within 10 years. Remember that you're not going to get the full $100,000 as a recipient. That comes off after it's already been taxed. So maybe you'll get $80,000 instead. Those are also subject to required minimum distributions, or RMDs, meaning that that type of asset can have a negative effect on the beneficiary's eligibility for government benefits if you left that money straight out to them, because they will have to make withdrawals based on certain ages, the age of the individual. And then there's assets such as real estate. We have those assets or securities that we own, and we're looking at maybe wanting to get those off to the asset value off to our special needs heir. But we have to remember that sometimes it's not easy to sell a home, right? And so the immediacy of that money doesn't come to you right away. Or maybe the value of it needs to drop because it's a buyer's market and not a seller's market. So that is another downfall with real estate. Now, life insurance is a great way because it's a little different. If you get it on the lives of the parent that's establishing this third-party trust, it can be a way of getting money into the trust quickly. We just need a death certificate, and basically that within a week we can get you your check. It's very quick. There aren't market valuations or anything to worry about there. It just comes out nice and quick, and exactly for the amount that they've told you about, and then it comes out tax-free. So there's a lot there. And like I said, it happens basically right at the time of death. So now we're going to talk about funding this special needs trust. So we've got our parents here, or we can have a legal guardian. They're going to establish the special needs trust during their lifetime. We're going to fund the trust through a purchase of a life insurance policy. And so the special needs trust will purchase the insurance policy, and then at the death of the parents, the special needs trust will now get a death benefit equal to the amount of that policy, and it gets paid off to the special needs trust then. So that's how it gets funded. So again, why are we considering life insurance then? Well, I told you a couple of these already, but we've got income tax free. In fact, I just had a client whose spouse passed away, and she got $150,000 death benefit from his insurance policy. And she called me up very concerned. Carrie, what is this going to look like once we pay taxes on it? And I said, well, the great news is you won't have to pay taxes. She was so elated over that. It made her day knowing that there was nothing, there were really no strings attached to that. It was really a benefit that meant a lot to her. So it's generally paid out income tax free. There are some very specific ways that it could make it so it was not income tax free, but generally, okay, speaking, it is. And it's generally available very quick, like we mentioned that too. So we need some proper documentation to make sure that that gets verified. And once all that's received, that check is quite quick. And, we say 7 to 10 business days, but it can be quicker if you have it go directly to a bank account. It's usually received without going through probate. So as long as you have a beneficiary designation on there, then it won't go through probate. And a lot of folks find that really to be a big bonus. Going through probate delays things. It has its own fees, and it's also made public, so people can see what's been paid on that. So if you can avoid probate, that isn't a bad deal at all. And this generally does. It's also not government dependent, like we were mentioning before. We've got that whole issue of those government funding programs having the ability to change the amount that would be paid to you with whatever whim they feel like doing that for. And that's definitely a downfall, but it's great to know that this is aside from that. And then lastly, there's leverage. We keep talking about leverage. Basically, if you look at this picture here, you can see you put in just a little bit of money and it turns out to be a big guy in the end. That is leverage. So you get, for every dollar you pay in premium, a larger death benefit to be paid out. So you're really getting a lot of bang for your buck, so to speak, versus just giving the premium that you would have otherwise, paid. That is the money you could just give to your special needs heirs, special needs trust, but instead you can make that even bigger by getting the life insurance policy with the leverage. So with life insurance, you have options. Okay, there are optional riders that you can get that generally come at an additional cost, but those riders can cover quite a few different scenarios. But what we're going to get started with are the two basic types of life insurance. We have term and permanent life insurance. So let's go over them. Term. We've got term insurance. The payments stay consistent for the duration of the period. It is a guaranteed death benefit for a specific set of period of time. Okay, so you can set it up for 10 years, 20 years, 15, even 30 years in some. Now, let's just say we have a 10-year period for our policy. You'll pay that same premium throughout that 10-year period of time. A lot of people like term because they can get it relatively easy. It's relatively inexpensive, comparably anyway. And you can also oftentimes get it through your work or your employer. And so that right there is often even doable without underwriting. And it's great while you're still at your job because that is something that often, like I said, can just be easily applied for. It's not overly expensive oftentimes, and it just doesn't take a whole lot of extra work to get that set up. Now, in many cases, you have the option to even convert that term policy to a permanent life insurance policy if you were to leave the employer. So that's often the case. Now, there's permanent life insurance. That is a different type of policy altogether, because this is meant to be there for your entire life. So this is more like a whole life policy or a universal life policy. Those policies are meant to be around for the day that you pass away. And so it could be purchased at age 15 or younger, but let's just say as early as 15. And it's designed to be there if you live to 121. Okay, so it is a little bit more expensive because it is built with two components. It has the component of paying for the actual cost of insurance for you during that 1 year. Every year it gets a little bit more expensive because, right, you're getting a little closer and you're aging. You're getting a little closer to the time it may need to pay out. And so when that happens, the insurance portion goes up a little bit every year. But out of your premium, which typically you can set it up so that it would be the same every year, anything that is paid in that is more than what it actually costs to insure you goes into a little savings account. You can invest that if you went into a variable plan, or you can just have it earning a set interest rate. And those policies have that cash value that some people talk about, where they say, I can borrow against my life insurance policy, or I cashed out my life insurance policy. That would be one of these policies. Okay, so those are the two main policies. Now we're going to talk about which one is right for you. So when would we consider term life insurance? Well, if you're just starting your career, you've got limited cash flow, term is often less expensive. So it's a great option for you. If you've taken on significant debt for a certain period of time. So, many people just want life insurance just enough to cover the fact that they have a 30-year loan on their home. And once their home is paid off, they no longer need term insurance or insurance at all. So they just get it, that insurance lined up with the length of their mortgage. If you maybe have kids in the house and those kids are going to be moving out, hopefully, in the next 20 years, maybe you'll just get a 20-year insurance to make sure that the kids are covered if something happened to you during that time. That is a great time for term insurance. And when should we consider permanent insurance? Well, when your need is indefinite. So basically, if we have a special needs heir, that need doesn't go away in just 20 years. It's going to be there regardless of how old I am when I pass away, right? So that is a great reason to have the permanent life insurance. Another one is, as we talked about, that whole, we can cash out the permanent life insurance. So we can save for retirement with that plan. We can keep, and I didn't put a little bullet point for this, but it's a way that we can even borrow money too, if we felt like we needed that ability in the future. So permanent life insurance is often a better choice for funding a special needs trust. It is not absolutely guaranteed that, that would be the better one, but that is often the case. So we're still going over what policy is right for you. When we have temporary life insurance or term insurance, the advantage is that it's lower cost. The permanent life insurance, the advantages there are that you've got some growth potential for the cash in there. So if you need to borrow from it or you need to cash it out later, it can grow. It can also be converted later in life to a different type of policy, such as a long-term care policy Or you can even, in some of these programs, use the life insurance benefit that would otherwise pay out at death as a death benefit. It can pay during your lifetime if you have a critical illness, you are terminally ill, or you're in a long-term care situation. And the other benefit is that it will last for your lifetime. So, like we talked about, temporary life insurance is term. On the permanent life insurance side, I'm surprised by myself. I didn't write whole life in there, but you've got lots of options. You have universal life, indexed universal life, variable universal life, survivorship universal life, and survivorship variable universal life, and whole life. So did you know? We're going to look at some quick, simple facts here about life insurance that might surprise you. So, did you know that the future benefit payment will pay more than the premiums you paid in? Oftentimes, the amount paid as a benefit compared to the premiums paid in is so high, it's equivalent to investing the premiums in a high-paying investment or even a high-paying CD. That's known as internal rate of return, and all of your insurance agents are able to show you what the equivalent rate of return would be if you were to take that premium and have it invested in the market to get the same end benefit as it would if you paid it in as a premium and have the death benefit get paid in the end. And it's always actually kind of fun to see what those internal rates of return are, because they're, especially within this first, I'd say several years, that internal rate of return is enormous. It's very big. Okay, next. It can be budget friendly. It does not have to be expensive to have life insurance. You can combine the use of both term and permanent insurance because it can fit your budget better. So you might be saying, yeah, I liked the idea that I had enough insurance to cover my mortgage. And then once my mortgage is done, I don't need that insurance anymore. Maybe that's a $300,000 policy, for instance. But we did our homework and we figured that you needed $1.5 million in life insurance for your special needs trust to properly fund that. Well, the 1.5 million should probably be permanent because we need that for indefinitely, right? That need does not go away. But my home loan will. So the $300,000 life insurance could just be a 30-year term policy that is for the duration of my home loan. And once that's done, then I no longer have that policy and I no longer have to pay that premium. That's a nice way of combining the two to make it a little bit more budget friendly. Life insurance can equalize an estate between special needs heirs and other children. So maybe we would use this to equalize the estate so that the special needs trust would get the life insurance and the other non-special needs children or heirs could instead get the business that you own, and they could get the business assets, or maybe they would get your retirement accounts. There's many different ways of equalizing things so that everybody gets the best asset that fits them in their need best. And then we have riders. There are riders on life insurance policies that can enable the policy to pay for both long-term care costs without even affecting the death benefit. It actually can do both, which are pretty cool too. So there's lots of different things that life insurance can do, like cover two very important threats, like death or even premature death, or long-term care, expensive long-term care costs. And that can be achieved through a life insurance policy. So now let's look at when we're looking at purchasing a life insurance policy, things that we need to be aware of. Okay, so the importance of financial strength is a big deal. All right, so you want to feel confident that when your loved ones need their benefit, when they get that benefit payment, because you've now passed on, that asset or that company will still be there, and that they're going to be good for the promise that they made to pay this benefit. So we want to make sure that they have high ratings. Ratings are factoring in a company's liquidity, their interest rates, their investment risks, their financial stability, their competitive positioning, and even more than that as well. So it's basically just their ability to pay on their claim. So there are several ratings agencies out there. AM Best is often one that I would look at for life insurance. All these others are also quite important. Then there is also another rating or ranking to check, and that's called a Comdex. So a Comdex is something that is a combination of all of those things, and it basically ranks them, and it makes it more on a level playing field, because AM Best's their rating scale looks different than what Fitch's rating scale looks like versus Moody's. AM Best's highest insurance company rating is an A++, whereas in Fitch, in the Fitch's program, it's AAA, or with Moody's, it's, well, and those were all capital A's on top of it all. With Moody's, it's capital A and small a, small a. So you can see how that's a little confusing. So the Comdex just ranks it and makes it more of an apples to apples for comparison purposes. Okay, so we are going to recap things. So there are several government benefit programs out there. They can only go so far. They can only promise you so much because we know that they could change. And we need something that we can get access to for additional funds above and beyond what those are paying as well. And so government benefit plans are wonderful, but they are not the full answer. Special needs trusts are really a great supplemental piece, and we went through what they are and when what type of various assets can be used to go inside them, and what the funding process would even look like if it were funded through a life insurance policy. We discussed the reason why you might want to consider life insurance as a way to help fund that trust. So again, mainly because it's generally paid tax-free and pays more than what you paid in for premiums. There are the two types of life insurance out there as well. And how to know when you can use them or should use them is really important. So we went over those, knowing that term insurance covers you for a period or term of time, and permanent will cover you for your lifetime. And then lastly, the importance of carrier ratings. So just check the insurance carrier's ratings and ask your agent and ask for the internet. Sometimes will even be a helpful piece too, to give you a little bit more answer on what you could or should be looking for.